Here's what I'd actually do if I were buying my first house in 2026, starting from zero. Not what I'd hope for, not what sounds good in theory, what I'd actually execute. Because here's the thing most people are not going to tell you about. If you're sitting around waiting for rates to crash back down to 3% or for prices to suddenly drop 30%, you're going to be sitting around waiting a very long time, maybe forever. But that doesn't mean buying a house in 2026 is a terrible idea. It just means the playbook has changed. The people who win in real estate, they don't time the market. They structure the deal correctly. And if I were starting from scratch today with zero equity in zero previous homes, here's exactly how I'd approach it. First thing I'd do, I'd stop obsessing over interest rates. I know that sounds maybe a little crazy coming from a mortgage guy, but hear me out. There's no doubt about it. Absolutely, mortgage rates matter. Of course they do. But terms matter more. And here's what most first-time buyers don't realize. The average person keeps their first mortgage for about 7 years. 7 years. Not 30, 7. You're not marrying the rate. You're dating it. You've heard that, date the rate, marry the house. Well, there's some truth to that. Life changes, job changes, families grow, markets shift, and when they do, you refinance or you sell the house. What you're really buying isn't a forever rate. You're buying payment comfort and flexibility right now. You're buying the ability to stop writing rent checks and to build somebody else's wealth. Once I accepted that mindset shift, everything else got clear. Because suddenly, the question isn't, is this the perfect rate? The question becomes, can I structure a deal in a way that works for my life today and gives me options tomorrow? And the answer to that question in 2026 is absolutely. Here are the exact tools I'd use. Strategy number 1, low down payment loans. Let's kill the myth right now. You do not need 20% down to buy a house. You don't even need 10%. In a lot of cases, you don't even need 5%. Most first-time home buyers qualify for programs that require 3.5% down or less. Some require absolutely zero. Here's the breakdown. FHA loans, 3.5% down, and they're flexible on credit score and debt to income ratio. If your credit isn't perfect, but it's decent, this is probably your lane. VA loans, zero down payment if you're a veteran or active military. Hands down, the best loan product that exists, no doubt about it. USDA loans, zero down in eligible rural areas and suburban areas. And before you think rural means middle of nowhere, check the map. You'd be surprised how many areas actually qualify for this loan. Conventional loans require as little as 3 to 5% down for strong buyers. Clean credit, stable income, this is the path you want to go. Here's what most people don't understand about these programs. None of them are bad loans. They're not subprime loans. They're stepping stone loans designed to specifically help people get into homeownership without waiting a decade to save up a massive down payment. The banks aren't doing you a favor. That's clear. They're making money on good loans to qualified buyers. You're just using the system the way it was designed. Most first-time buyers qualify for something. It may not be exactly what you want, but you probably qualify for something. They just don't know which lane they need to stay in. Strategy number 2, down payment assistance and grants. This is where people's eyes, they just get wide because this is the part most, really not everybody talks about, or really not a whole lot of people talk about. There are local and state programs all over the country that will help cover your down payment, your closing costs, and sometimes both. And I'm not talking about sketchy programs or loans you have to pay back. I'm talking about actual grants and forgivable loans that pair with FHA or potentially conventional loans. In Georgia alone, there are multiple programs depending upon the county. Some will give you as much as $12,500 towards your down payment. Some will cover the entire closing costs. And here's the kicker. A lot of buyers qualify without even realizing it. You don't have to be below the poverty line. You don't have to be a single parent or a teacher, although some programs do prioritize those groups. Many of these programs are income-based, and the income limits are much higher than you think. If you're making $80,000 or $90,000 in a household, you might still qualify depending upon where you're buying. Now, let me be clear. This isn't free money for everybody. There are rules that matter. Some programs require you stay in the home for a certain number of years. Some have income caps. Some are first come, first served until funding essentially runs out. But for the right buyer, this is a massive unlock opportunity. If I were buying in 2026, I'd spend an afternoon researching what's available in my state and county before I ever started looking at houses. Because finding out you qualify for $10,000 in assistance after you already made an offer, well, that's just leaving money on the table. Strategy number 3, seller concessions and rate buy downs. This is where negotiation becomes more important than the price, and your real estate agent really earns their commission. Let me explain. In a normal market, and we are getting towards a normal market, sellers pay for things all the time. Closing costs, repairs, title fees. But in 2026, if the market stays where it is or softens even a little, you can negotiate for the seller to buy down your interest rate. So here's how that works. Let's say you're buying a $350,000 house. You negotiate for the seller to contribute $10,000 towards closing costs and a rate buy down. That's $10,000 that can be used to temporarily lower your rate for the first year, second year, and even 3 years from the initial inception of the loan. It's called either a 2-1 buy down or a 3-2-1 buy down or a 1-1 buy down. So instead of starting at 6.5%, you might start at 4.5% year 1, 5.5% year 2, and then back to 6.5% year 3. The lower payment in year 1 gives you some breathing room. It gives you time to adjust to the homeownership costs, and it gives you time to refinance if rates actually drop. No guarantees, but it is a possibility. The seller isn't writing you a check. They're just agreeing to pay the lender fees that reduce the rate. And in a market where homes are sitting longer, sellers are often willing to do this to just close the deal, just get to the table. If I were buying in 2026, I'd be asking for seller concessions on every single offer, not because I'm cheap, because I'm smart, I'm intelligent, I want a better transaction. In 2026, negotiations matter more than the price. Your real estate agent earns their commission in 2026. Strategy number 4, I'd buy the starter home on purpose, not my dream home, the starter home. And I would do this with intention. And here's what I mean by that. Your first home is not your forever home. You're not going to live in this forever. You're going to utilize this as a financial tool. It's the house that gets you out of renting, starts building equity, and sets you up for house number 2. Now, this could be a condo, could be a townhouse, could be a duplex. It might be a smaller single-family house in a solid neighborhood with a great school system. And if you're really wanting to accelerate things, I'd consider doing some house hacking. Buy a 3-bedroom house, rent 1 or 2 of the rooms out to friends or some sort of roommate. Let them cover half of your mortgage while you live there. Or if you can find a duplex, buy a duplex, live in one side and rent out the other. After a few years, you move out, keep it as a rental, and use the equity and cash flow to buy your next place. This is how people build wealth in real estate. Not by buying the absolute perfect house on day 1, but by buying a smart house. Because here's what happens. You buy the starter home in 2026. You make payments for 3 to 5 years. Home values appreciate, even if it's going to be modestly, let's just even say 3%. You're paying down the principal balance every single month. And then suddenly you've got $50,000 or $75,000 in equity. That becomes your down payment for that bigger house, the better neighborhood, the better school system, the place you actually want to raise your family. But you can't get there if you never start. Simple as that. If I were buying in 2026, I'd be looking at properties through the lens. Does this get me in the game? Not, is this my dream house? So let's bring it all together. If I wanted to buy a house in 2026, here's exactly what I do. Stop waiting for the perfect rate and start focusing on structuring the right deal. I'd figure out which low down payment loan I qualify, whether it's an FHA, VA, USDA, or conventional loan. I'd research down payment assistance programs in my area even before I talk to a real estate agent. I'd negotiate hard for seller concessions and rate buy downs to lower my payment in the early years. And I'd buy the starter home on purpose, knowing it's just a stepping stone and it's not the finish line. That's the playbook. Look, it's not super sexy. It's not wait for the crash and then swoop in. It's just smart, it's structured, and it's executable. And here's the truth most people don't want to hear. The best time to buy your house was 5 years ago. The second best time to buy is right now. Not because the market is perfect, because sitting on the sideline costs more than you think. Every single month you rent is a month you're not building equity. Every year you wait is another year you miss out on appreciation. And if rates drop in late 2026, 27, or 28, fantastic. You have an opportunity to refinance. But if they don't, you're already in. You're already building wealth. You're already ahead of everyone who's still waiting. If you're thinking about buying in 2026, the smartest move isn't guessing what the market will do. It's getting on a plan based on your actual situation, your income, your credit, your goals, not someone else's timeline. Reach out and we'll map out the cleanest path for you. There's no pressure. There's no sales pitch, just a real conversation about what's actually possible. Because the people who win in real estate don't time the market. They structure the deal correctly. And that's exactly what we'll do together. And that, I don't know if you've heard this, but it's guaranteed.